Last week, a lab in China shipped an artificial intelligence model that undercut America's best on price, and the entire chip market came apart. Worst week for semiconductors in over a year. Then, 3 days later, that same lab had to stop taking new customers because it ran out of the one thing it could not download: chips. That single fact quietly undoes almost everything the market decided last week. Let me show you. Okay, the setup. Because you need it to follow this. A Chinese lab called Moonshot released a model named Kimi K3. Two things made Wall Street sit up. One, it performs near the top tier. Two, it costs about 40% less than the comparable American models to actually use. Not half, 40. And they've said the model itself goes fully public on July 27th, which means anyone will be able to take it and run it themselves. Good enough, cheaper, and about to be handed out. The moment the market did that math, it panicked. And here's the story everybody told. If intelligence is about to get cheap, then the trillions being poured into chips and data centers can never earn it back. So sell the chips. And they did. Hard. The main semiconductor index fell 12.5% in a single week, its worst week in more than a year, and it's down about 20% from its June high. Chip funds just had their worst month since 2008. One release, one price sheet, and the market reached a verdict on the biggest build-out in corporate history in about 6 hours, which should always make you suspicious. Except 3 days after that release, Moonshot paused new subscriptions. Not because demand was weak, because demand in the first 48 hours came close to the ceiling of the graphics processors they had available to serve it. Read that again. The company that supposedly just proved the world needs fewer chips had to turn paying customers away because it did not have enough chips. And this is the mechanism the whole panic skipped. There are two completely different costs in artificial intelligence, and the market keeps mashing them together. There's the cost of building the model once, and there's the cost of running it every single time somebody asks it a question. Giving the model away for free kills the first cost. It does absolutely nothing to the second. This thing has trillions of parameters. Every answer burns real electricity on real hardware, somewhere. So when you hand a powerful model to the entire planet, you don't reduce the demand for computing. You multiply the number of people who suddenly need some. A free model is not a chip problem. It's a chip demand event. Now here's the part that should have ended the argument before it started. 2 days before that sell-off, ASML reported, "This is the Dutch company that makes the machines that make the most advanced chips on Earth, and it is effectively the only company on Earth that makes them." It raised its full-year sales guidance to 43 to 45 billion euros, up from 36 to 40. That is a raise of several billion euros, and it's the second raise this year. It also said it's increasing its capacity for the most advanced machines by about 30% for next year, and looking at another 30 on top of that for the year after. Customers are signing longer agreements. Visibility now stretches into 2027 and 2028. That is not a company staring down a demand collapse. That is a company that cannot build fast enough. And then there's the tell, the number that made me sit up. In the exact month the chip complex had its worst stretch since 2008, down more than 18%, chip funds took in record inflows. Around $6 billion. The most ever. Price collapsing. Money pouring in. Those two things do not happen together when the story is that demand is dying. They happen together when a crowd is dumping something and somebody much larger is quietly taking the other side of it. Now let me argue against myself properly, because otherwise I'm just selling you a story. 3 real ways this read is wrong. 1. The commodity end of chips, the memory makers, genuinely can get crushed in a price war. That memory fund is down almost 30% this month, worse than the broad index, and lumping it in with the bottleneck suppliers would be a mistake. 2. Order books lag. They tell you what customers committed to months ago, not what they'll do if they panic next quarter. If the big spenders actually cut, a backlog is the last thing to find out. And 3. A shortage today is still a shortage today. Build enough capacity and you eventually get the glut everyone fears, just later. So the question isn't whether the fear is imaginary, it's whether the market just priced it about 2 years early. So here's the test, and I'll put it on the record. Watch orders, not headlines. If last week was really a demand event, it shows up as canceled orders and cut spending guidance from the equipment makers and the leading edge factories. My call. It won't. What you'll see instead is the split widening, the bottleneck names holding up better than the commodity memory tier, and the actual margin damage landing where it belongs, on what anyone can charge for tokens. Intel reports Thursday. That's the first honest read on whether this is demand or sentiment. And on July 27th, when Kimmy's model goes public, the claims finally become testable by people who don't work there. If canceled orders start showing up, I'm wrong, and I'll say so right here. Here's what I'd take away from all of it. Markets are excellent at pricing news and terrible at asking which question the news actually answered. Last week's question was, what is intelligence worth? And the answer came back, less than we thought. But an enormous number of people heard something completely different. They heard, the world needs less of it. Those are not the same sentence, and the entire gap between them is where the money is. So the next time the fear is that artificial intelligence is getting too cheap, ask why the one company that makes it physically possible just raised its guidance by billions, and why the cheap challenger had to close the door. Earl's full daily brief is on the channel. I'm Frankie, the asymmetric signal. One contrarian read a day. Subscribe.